Okay, so we were previously Internos, which we'd founded 10 years ago. We sold the firm to Principal Real Estate of Des Moines, Iowa. They are, amazingly, the 9th largest fund manager in property in the world. You've probably not heard of them. And we focus, we're pan-European, so we have 8 offices. We have a number of vehicles. The main focus is a European core fund, a European office fund ex-Germany, a German retail fund, interestingly for French capital, which we could talk about, because that French slide put up might surprise people about the capital coming out of France. And then a hotel fund series that we run, and they're the principal vehicles.
Great, thank you. Kim.
So I'm Kim Politzer. I'm Head of European Research at Fidelity. We primarily have 2 core funds, one investing in the UK and the other one investing in core Europe, so focused primarily on France and Germany with a bit of Benelux in there as well as some separate account money that is also invested in those core European markets. And our focus is very much on looking at the core plus part of the market and really focusing on doing that well from a stock picking perspective. And I bring in some discipline from the top-down side of things.
Alexander Fischbaum, AF Advisory. Before I started my own firm, I used to be the head of real estate mezzanine at Barclays Bank and then worked in Barclays Capital, their investment banking division, also in real estate, and moved on to become investment director at Orion Capital Managers, one of the most successful pan-European real estate private equity firms. And 6 years ago, I struck out on my own. We're a small firm with a couple of staff members, and we do exactly what I used to do before, and I would summarize it at deals and debt. So focused on the UK, Germany, and Netherlands, because that's where we have our best connections. We do 2 things for our clients. A, we source deals for them, we analyze them, we underwrite them, and structure them, including the financing and everything else, and run the entire acquisition process, or asset manage if required at the end. Or we source debt, and our clients can pick and mix which part of the entire process they want to have. Some of them want to do the entire thing, find us an asset, a good deal, acquire it for us and finance it. Others come to us with their transaction ready and say, can you find us the debt? And we then work around our clients' requirements, where they may have a shortfall in capacity, manpower, local experience, connections, and make the whole process happen.
My name is Stephen Miles. I work in a 20-strong team in London, working across our capital markets businesses, which has about 400 people across the region. We also work with our global network. We're focused in London. The team focuses on the larger transactions we work with across the region. We do cross-border portfolios in this team, and we also move some of that global capital around the region. The team in London is basically split between logistics, retail, and offices, and my specialism is in offices.
My name is Morag. I'm a good old-fashioned general practice chartered surveyor, and I did at one point in my CV, if you look through it, I was Heineken's pub acquisition manager. So I was Morag pub acquisition manager. So I'm kind of used to fun being poked at my name. As I said, I'm 30 years as a chartered surveyor. I have chosen in the last year to focus in on the residential market and to focus on working with a technology company in residential investment, because I believe those, particularly with the UK market, there's a lot of scope there, not only from a demand from occupier side, but also from investors who are aware of the residential market across Europe and in the US. So I think there's a lot of potential there. I think what technology has to lend to property is enormous, and I think we're just scratching the surface of what the potential is for that there. So personally, I think it's really exciting for me with my grey hair to be sitting in the WeWork. There are other options available for flexible office space. It's not everybody's choice, but it's actually very interesting to see what a younger perspective coming from a non-property background can see potential within the property investment markets.
Okay, good. And it's one of the things that I wanted to pick up in this as well is how do we see some of those bigger trends that are influencing real estate rather than just the day-to-day things that we often look at. Let's just pick up some of the things from Neil's presentation in terms of the macro side. And maybe start with you, Kim, if we can. So we've got GDP growth, high employment figures in various places in Europe, but particularly if you look at Eastern Europe, very high employment figures. How, I suppose, do you see the macroeconomic factors influencing real estate through next year?
I think it's going to be, as Neil has suggested, I think 2019 is going to be an okay year. It's going to be quite similar, I think, to this year in terms of the numbers that we're seeing in GDP growth, the sort of demand we're seeing for occupying real estate. And it's difficult to be negative, but as Neil said, you got that feeling that we are getting closer to the end of the cycle. So I think over the next 12 to 18 months, one of the things I will be doing is watching much more closely for further signs of the end of the cycle. But I think from an occupational market side of things, the fundamentals look okay at the moment. There's nothing that says there are real storm clouds on the horizon, and certainly when you start looking at the macro take-up data, or even our experience when we're releasing space across much of Europe, we're certainly not seeing enormous challenges in leasing up that space, and occupier demand seems to be there. So I think 2019 looks to be set fair for Europe. I don't see it being a big boom year for rents because we are starting to see that supply coming through. I think there's quite a lot of second-hand space that is going to be released because people have pre-let new space. And I think that will be interesting to see how that is refurbished and reabsorbed into the stock, and whether people get the performance out of that more value-add strategy that they've been taking that asset on for. But overall, I think it's going to be a decent year.
Okay, good. And Jos, maybe pick that up. And also, I mean, Neil mentioned it, but it's been mentioned in a lot of the sessions that we've been doing, is political risk. It doesn't seem to have, I mean, it was interesting, that chart actually about the equities and the REITs, I think. But it doesn't seem to have influenced so many things about the European market, in a way, surprisingly to me. What's your sense of that? I mean, certainly in Germany there seemed less concern about Merkel's departure, more concern in France about that, less concern in France about the Gilets jaunes, and great concern about that here and in Germany. But what's your sense of that? And I suppose, is any of that making a difference to your investment strategy?
Wow.
Can you answer in one word?
I think let's try and start. I mean, I've got a 35-year working career, so I'm quite old. In the 17 years I worked in the city, frankly, the city didn't really care too much about politics. But I think the whole sort of volume around politics has gone up enormously. And latterly 17 years as a sort of investment management professional. And I think really politics at the moment is one of the key drivers of what could cause some sort of event that destabilises the outlook that CBRE and Fidelity have just spoken about. Because I tend to agree. I think we've all been sitting around our investment committees saying, it is going to come to an end, and we've been saying that for about 24 months, and yet we've just been going along. And that UK REIT graph that you mentioned is amazing, because basically those stocks have just crabbed sideways. I mean, absence obviously Into and Hammerson, and possibly even Land Securities and British Land, but they have just crabbed sideways. And people like Great Portland, where I was on the board for 11 years, we positioned ourselves beautifully for an event where we thought goodies would fall off the back of a lorry in central London, and it just hasn't happened. They're lowly geared, they're ready to pounce, but that repositioning isn't happening. I think to answer the third question about sort of capital, I think it all depends who you're representing. So I think if you're an opportunistic fund, life for you in Europe is pretty difficult at the moment, because you're massively struggling to get anywhere near the returns you're meant to be achieving. If you're investing like we are for this French retail money, We're investing for them in German edge of town, sort of fact market centrum property. We've been doing that for 4 years. For those retail investors, it's all about a coupon. You know, they're getting 0, or even last year less than 0 in SocGen and BNP Paribas. So they were all about yield. So actually what we're buying for them, even though it's expensive, they're happy. So I think in a way, the way you position yourself, the way you look at the markets, what you're buying, a lot of it depends on the underlying capital you're representing, their appetite and tolerance for gearing, and their appetite for income return. And I think that you can't underestimate that income return. I think as the population gets older, long income, particularly index-linked income, is more and more valuable for pension funds. And you could argue on an actuarial basis is still actually relatively underpriced today, even though it feels to us like it's very expensive. And hence all the move to infrastructure and other assets. I think that's a big driver of investment management and returns, which is underestimated at the moment.
Okay, good. Does anybody else want to pick that up? I'd be interested to get from you, Stephen, just in terms of, is the political question becoming more of a discussion in terms of international investors looking towards the markets?
You know, I've been working in the European capital markets for about 20 years now, and definitely this is the first time that I've actually had to have a sort of considered view on the political landscape. It's definitely something that when I go, if I'm travelling, you know, out of region, people want to talk about. They're reading headlines. They want to know what's going on. But I think at the end of the day, it's about the economy, and it's about just the metrics of the different markets they're looking in. I think there's noise around some of these political events. Some of it will, you know, clearly have impacts on the economic performance of those countries. But I think there's still a lot of noise. I think it's difficult to filter out, you know, what's real and what just grabs today's headlines. So it's definitely more a part of the discussion, but I still, you know, end up focusing on what's going on in the economy, where the demand is, and what the markets are performing, you know, how they're performing. So, yeah, it's more of a discussion, but it's not, I wouldn't say it's a key factor.
Okay, good. And let's just pick up briefly Brexit. I'll give this to you, Alexander. It's
a German good idea.
We've been talking for a while about this privately as well as on these sessions sometimes. I delayed this event because I thought that there would be more clarity by the time, more for me. So I thought that would be the case, but it obviously isn't. How do you see it at the moment, and how do you see the risks around that? Or do you think it's all going to end up as some, you know, essentially it's really not going to make a huge amount of difference over a period of time? Something will either be cobbled together or not, and does any of it really matter?
Thank you for that easy question. I think this and the previous question are actually more linked than we all think. And I wanted to add to what Neil very interestingly said. I think we are seeing in Europe and in the United States definitely a change of underlying attitude to politics. And that blows out from time to time. It's not a linear change, but just like the graphs we've seen, there are spikes. We see the bust up with the Gilets jaunes. We have the Brexit vote. We see in Germany a very strong changing political environment. And that is driven by disaffection of a part of the population, but also by a changing makeup of the underlying population and their aspiration. There is a part of people who don't feel part of the system, who don't want to be part of the system, or who want a completely different system. So the order is changing. And if we then read in the newspaper or in BBC that we have a constitutional crisis, yes, it's not very pretty to find a government being held in contempt of parliament. That's the mother of parliamentary democracy not something I expected to see, but it are these individual flashpoints. They will revert to the mean, but the mean is changing, and I think that is the bigger question. So coming back to the Brexit question, I have said from the very beginning that I think common sense will prevail. I must admit I hadn't quite factored in the negotiation prowess, to put it politely, of our Prime Minister. But even then, the interdependence between UK and continental Europe is such that UK exports 240 billion a year, euro, and imports 280. It would probably be in everybody's interest to find a sensible deal, and if Parliament doesn't accept it, and we'll have another prolongation period and another negotiation, because crashing out of it, I think, is not of real interest to anyone. Germany and France are experiencing delicate political situations, and those are two of the biggest investors into the UK. And if you see many of the energy companies, many of the car companies, something like this, whose profit would be significantly hit, and thereby the tax take, I think at some point in time realism will have to sit in at both sides.
Okay, good. I'm going to park that for a minute, and I'm going to come to investment and technology in a second, but I've got a question in from Mark, so thank you for that, which is, are we in danger of talking ourselves into the end of the cycle? When the downturn comes, do the panel see it being a correction or a full-blown downturn? Which also may be talking us into the downturn. I don't know. So maybe a self-fulfilling prophecy. What do we think? I mean, interestingly, in Paris and in Frankfurt, there was actually quite a view that yields could still go down, that fundamentals were good, and that you could be on a plateau. Everybody was agreeing that it was sort of plateauing, but that could be for an indefinite amount of time, no doubt similar to the backstop. What's your sense of that? So let's pick up the point from Mark there. Are we all talking ourselves into a downturn or not? Anybody can take that. Or not.
I don't think we're talking ourselves into a downturn. I think that certainly in the short term we're going to see a period of stability. But I think that we're also, I've seen so many forecasts over the last 12 months or so, which have this beautiful, the capital goes down to zero, the income line stays nice and stable at around about 4 to 5%, and then at the tail end that capital starts growing again. That's not how property cycles usually turn out. So I think if and when we do get a correction, it won't be as simply capital growth going down to zero and then bouncing back again. We will see some big corrections. And I think one of the things that I'm concerned about is particularly risk at the prime end of the market at the moment. So a lot of people are talking about prime being a safe haven, but when we've got yields below 3% in some of our major European markets, a 50 basis point correction on that 3% yield is something approaching a 15% correction in capital values. So I think that that's something we have to be very aware of, that a small correction in yields off a very low yield base is going to have a big impact on capital values. And I don't think a 50 basis point yield shift on some of these prime yields is unreasonable as a correction when it comes.
Yeah, and I think you probably have to look back at history to attempt to predict the future. And if you look at the crashes in UK real estate, the first was interest rate and development led. The second was sort of tech bubble led. And the third was clearly Lehman, which was pretty horrendous. And then you've had Mark Carney being asked to predict, or prediction's the wrong word, scenario plan a worst case for a hard Brexit. And I think he was saying something like 47% fall in commercial property values and pretty similar in residential. So it was pretty ugly. So I think to say if and when the correction comes, I doubt it'll be a bump in the road. You know, it's normally pretty severe. Things happen much faster than people anticipate. Yields blow out quicker. You know, look what happened to US Treasuries this year. You know, the 10-year Treasury blew out way faster than people thought. I mean, it went to 3.4-ish. I think it's now back under 3. But markets do have a tendency, even in underlying physical property, which was way less liquid, to move way quicker than you think.
Yeah, but I think that's fully right. And I just thought I'll read out a couple of 5-year government bond yields, because in the end, much of what Jos rightly said of the pricing is driven by availability of capital and their investment alternatives. And if we have here list Australia 2.1, America 5-year 2.8, UK 1 roughly, Germany, Japan, Netherlands, all negative, France 0.0. As long as that doesn't change, in an aging world, as Jos said before very rightly, where there is a focus on income, it is not easy to see how Mr. Carney gets to his 47% personally. He has been very bearish. In reality, there are lots of investors in the room who have raised and allocated capital to the UK. And if 20% a correction came, I would wonder how many of them would start immediately rolling out the cash and grabbing assets if there were good assets on the market.
Yeah, interesting. I'm going to come a little bit to you, Morag, just in terms of some of the broader trends. You mentioned the influence of technology there. How much of a role do you think that is going to play, especially for an influence, not only the market, but also then how that influences occupier demand? So some of those broader topics that you're looking at.
Yeah. I think technology, along with awareness of ESG, is something that is playing big in the property world. I mean, I think 5 years ago, ESG sustainability was something for investors that was vague. Somebody's got to take care of it in a corner. But now that is very much up the agenda, and it's now commonplace. And I think the statistics are something like 60% of institutional investors in Europe wouldn't invest with a fund manager who wasn't GRESB compliant, whatever the phraseology is. In terms of technology, I mean, 30 years ago, retailers were using technology to measure every single thing. If you ask Heineken or McDonald's how much did they sell today of a particular product at a particular point in the day, they knew that precisely. Office occupiers are now running with the same kind of scenarios. They know their space management to a finite degree of 7% of this office space is used for this, 10% of our energy is wasted on that. That really drives how they look at their occupational requirements and what their costs are. So I think there's a huge impact to be made in the office market with technology more pushing through from the occupier side. And a personal big bugbear of mine is that property market works in silos. So the core nets of the world, the office occupiers, do not talk to the in-reps of the world. They don't talk to the GRESs of the world, and there's a lot of communication there. So the technology is happening at the occupier side, and it's not being fully engaged at the investor side. So I think that it's really going to start hitting particularly office owners very in a big way very soon, because occupiers are going to readjust how they occupy buildings and what relationship they want there. I mean, from my perspective within IMMO, we are looking at the residential market. I've chosen to look at that. Our technology guys say to me, I work in an office full of engineers, and they say to me, do not publish any statistics about the power of our technology within this company, because it's so lightweight. I would never hire another development engineer. We are only scratching the surface in the property market of the capacity of what technology has to offer us right across the board of whether we're an investor or an occupier or an analyst. There's massive impact that technology can have for us, to the better good, I think. I mean, there's obviously caveats there, but...
And you mentioned there that you thought investors were behind the curve on this, really, but they're going to be forced to make changes because of the occupiers.
Yeah, because of occupiers and also alternative players coming into the market who are, you know, I will manage your investment, and you can see it on an app on your telephone exactly where you are today. With I think if you look at what APG in the Netherlands have done with their investments, particularly in Citizen M Hotel. They had every day, they don't wait for a quarter report, they press a button and it's there. They can see occupancy report right away. They know what the voids are. There's no waiting to go and check the Excel sheet that lists this month's rent or leasing. It's there. It's all there in a database, and there is a reluctance from the property side to adopt that. I realise there's a huge investment involved, and that fitting a database on top of a portfolio is very tricky. But I think the expectations are that the property market is really going to have to up its game because the technology is there to do it. And
Jos, is this something that you're looking at far more? Has there been? I mean, you were saying that the principal, obviously, large company coming across it. Has that changed some of the ways that you're looking at technology and the usage of that? And is that driven by the occupiers, like Morag is saying?
Yeah, I think not necessarily the technology piece of it, but I agree with everything you say. I think the disruption potential for technology and property is enormous. And everybody is thinking about it and looking at it and trying to figure it out. I think on GRESB and carbon awareness and all that stuff, Principal is very good in the US. I mean, sort of cutting edge on all of that. You can see it all on their website. And so we are very much benefiting from what they do there and doing it now here in Europe. And it's a key, I mean, we're in an RFP situation at the moment with a leading UK consultant. If you cannot seriously tick that box effectively and demonstrate it, you will not get hired by this consultant. So, and there's even more stuff around technology, culture of firms, all sorts of things that are going on in terms of manager selection today.
Okay, good. Stephen, you mentioned that one of your big focuses was office, and we saw in Neil's slide that actually, surprisingly, so far, office take-up in central London, as well as outside in the regions, has been positive. You've got also WeWork taking a huge amount of office space in London and growing in the continent. What's your sense of that? Will that bandwagon continue to roll also out in Europe in terms of office space, or do you think it's reaching where it's going to get to? What's your sense of that?
I mean, I think WeWork is very active, across Europe. I think it's just it's basically just creating space in cities that didn't exist before. That it's much more flexible. It's just moving towards a more sort of an economy where people want things as and when. You don't want to sign up for long term. So I think it's just matching the way that the economy is evolving, and you've got lots of startups, and they don't want to take leases, and just the way people are working today. Will that bandwagon continue? It's quite frightening looking at some of the numbers that WeWork throw out, but I don't see them pulling back anytime soon. There's a potential first mover advantage. Whether they will crush the competition, I don't know. A lot of landlords are being quite nimble now in creating their own sort of co-working environments, and some of those are pretty good. So what then? The global network of WeWork, what does that add that a local landlord can't offer? There's a big question over what that value really is.
And do you think that's going to be one of the bigger themes in continental Europe, that it will repeat? I mean, in a way, you have continental European markets following the UK logistics. Do you think the same will happen in terms of that serviced office space?
I mean, I think we're seeing it. I mean, WeWork, taking up buildings. They've taken up a large amount of square meter in Paris already, and they do feel that there's a copy paste element to what they've done in London. I think that's the strategy, and get in there before anybody else and get people hooked.
Morag, you want to come in on that?
Yeah, I think WeWork is only one of an offer. I think we call flexible workspace a WeWork the way we call a vacuum cleaner a Hoover. I mean, I think young people now don't actually realise Hoover was a company. I mean, I think
young people don't even know what a Hoover is.
now, there you have a good point. Young people don't know how do not work in WeWork because they do not know what Hoovers are. Absolutely not. I mean, I think there's actually a bigger fundamental issue there that we can address. WeWork is just a symptom of the fact that the property world pays a lot of attention to the relationship between the capital and the manager of the capital, and that whole investor relations community is a massive base, but actually looking the other way, where the income comes from to create the returns is from the occupier side. And I mean, I'm going to guess 10 to 1, 20 to 1 investment relationship managers outnumber tenant relationship managers, and the number of whatever side of the landlord sort of landscape you're on, the relationship with occupiers, understanding what they want, what will make them pay a good price to be in your property for a long time. That knowledge, that communication, that relationship is still a very adversarial landlord-tenant relationship. It has to work, that has to begin working like a partnership. WeWork does not operate a landlord-tenant relationship. You're a member of a club, and in joining that club, you have signed away quite a lot of rights. If you look at it, it's great. You can move in and out. Your desk is the size of a postage stamp. Your chair doesn't do ergonomically what it's supposed to do. Your access to daylight is less. But you get flexibility, so you're happy to agree with that. And I think there's a big opportunity there for the institutional management of buildings really to invest in their relationship with the occupier side to improve that relationship, which will then put, WeWork will be an example of how that relationship can work, but it's not the long-term solution. I think there's lots more ways to do it.
I mean, this is very specific, but it's an interesting example. When I set up my business 10 years ago, we took a lease in Grosvenor Street. I had to post a 450 grand rent deposit. So this rent deposit thing, which exists in the property industry, where it's got to be, I think, you've got to be earning 3 times that as net profit to then get that back. And then there's a big discussion actually when you hit that, are you going to get it back or not, right? So I think just the posting of that deposit for people, and when you're setting up your own business, is pretty difficult, which is possibly one of the many reasons that serviced office companies work. Yesterday I was with a tech entrepreneur who's set up a business where he's going to intermediate that rent deposit by basically an insurance contract. So you pay 30 grand for an insurance contract, the insurer takes the deposit risk on the tenant, i.e. the credit risk of the tenant. That unblocks the posting of the big amount of capital. And then any dispute, is basically done between the insurer and the landlord. Pretty cool. I thought that was quite an interesting product.
Interesting, yeah. No, that's I haven't heard that before. So
nor have I.
That's good. Stephen, you wanted to come in?
Well, I was just going to say, we've all seen sort of the serviced office providers come into the market before, and when you're buying long, selling short, that's never really ever worked out in whichever sphere you look at. I think the success of WeWork might also be predicated quite a lot on how they work with big corporates. I think they're trying desperately hard to make themselves the corporate real estate divisions of big companies. I'm still a little bit suspicious of the rate of expansion, though.
Okay, good. Let's pick up on some market specifics. Obviously, Alexander, you're looking at the financing side. What are you seeing? Are there any big trends that you're seeing in terms of the financing side that people should look out for in the UK or Europe more generally?
Yeah, we're doing deals and finance and looking at, as we typically do, the value add, core plus area, because core is not, debt is mostly not accretive, and opportunistic is very hard to find. I think we see in all countries that we focus on, UK, Germany, Netherlands, a lot of capital availability from a ever wider range of sources. So you see more and more entrants. And at the same point in time, many of these entrants have very specific requirements, so that although you have a plethora of potential financiers, if you come with a specific project, you end up with a defined number of entities who can make you a really attractive offer, because that's what they do. We're working, for example, in the Netherlands on a data center that's only 10% let, so that's a bit of a challenge. And although the Netherlands generally are a very well-supplied finance market, we have a clearly defined group of people who want to do that at a reasonable price immediately. When you go outside of London, we are working on a regional hotel chain that is not let to one of the big names. And it's not a lease, but it's a management contract. And again, these two dimensions, oh, it's not central London, oh, it's not a lease, reduces the amount of potential funders significantly. So the trend is to more niche approach and many, many more players.
Okay, interesting. And just in terms of what you're looking at, let's look a little bit at the sectors. Availability of product, how much of an issue for that is you? And finance, I'm assuming, is generally available aside from the areas where Alexandra is particularly looking at. What are you seeing in terms of the sectors particularly?
Well, we're really concentrating, I suppose, as I said earlier, where we have money to deploy. I think a general comment would be, yes, it's difficult because there's huge capital still available, and finding decent opportunities is difficult. So I think we were forecasting to do about $1 billion of transactions this year, so we're fairly small. That was about 250 of sales, 750 of acquisitions. We're probably going to do more sales actually than the 250. So selling into this market is obviously a good thing. And buying, we're going to probably be a little bit behind. So we said 750, we might do 550. So that sort of tells you we're not struggling, but we're finding it hard to deploy capital effectively to the sort of risk-adjusted returns we want. In terms of sectors, yes, hotels, healthcare, logistics, offices, because we've got an office fund, are all sectors we're targeting all over Europe. And typically in the main economies, so Germany, France, Spain and Italy is where we're spending most of our time. We're not doing much in the UK. That's more a history of legacy of the firm than the capital we can sort of currently have now. I mean, UK, I hear that agents are walking around every day with bucket loads of shopping centres to sell to people. And there is literally no demand. There were rumours that Blackstone were going to do one of their great macro plays and come into the UK secondary shopping centre market. I think if they did, that would be interesting because often what Blackstone does, everybody else follows, and it does become self-fulfilling. But I think retail in the UK, very hard at the moment. Very hard. I think look at London Metric. Andrew Jones moved them from bricks to clicks. He saw that early. He did it very well. A lot of people just were asleep at the wheel and over-levered. So it's a pretty dangerous combination, that.
And it's interesting. What's your view on the house view, I suppose, Kim, on retail? And I'll pick up a little bit on what was said in Frankfurt and Paris.
Well, you may have seen the article in the FT last week that grabbed some headlines about our forecast that retail values could fall between 20 and 70% in the future. And I think we are very pessimistic about retail, particularly in the UK, but we think some of those trends will spill over into Europe as well. It'll take longer because in the UK we've got this perfect storm of squeezed profitability on retailers because of increased minimum wages, because of increased rates bills, and that has really triggered a dramatic fall in profitability for retailers. So we've been working very closely with our equity teams at Fidelity, looking both at retailer profitability, looking at what the REITs data is telling us about pricing of retail, and then looking at our own experience. Now, we're very underweight to retail, so I think we're quite happy to be very bearish about it, but I think the reality is we've got to see some significant adjustment in pricing just because retailers cannot afford the rents. Those rents are going to fall, and that's not priced in by the valuers at the moment. And I think there is, but the challenge, I think, for the UK retail industry in general is how we repurpose a lot of these secondary shopping centres. I think there's we have seen local authorities starting to get involved. Whether they got involved in the right way at the right price, I think you can question. But there has to be a future for some of these centres in city centres because they're at the heart of communities. But I don't see it happening until we've seen that significant repricing. So there are people who are sitting on these assets who at some point are going to have to take the write down so that these assets can be repurposed so they're fit for their communities and fit for the future. And it won't all be retail, some of it will be minor surgery centres, local libraries, community facilities, perhaps day centres for old age people. But we've got to find a way of getting the pricing to a level where those sort of things can be brought in and produce an income line. But I think there's definitely a future for investors to work with local authorities to repurpose these centres. And the question that still sits at the back of my mind that got asked at Revo in September, when everyone was talking about experience and prime shopping centres, and there's always going to be demand for physical retail, which I fully buy into, but I question what the price is. Someone put their hand up at the back and said, what about Wigan? And that's the question. Wigan has a big shopping centre at the heart of it, but it's not the sort of place where you're going. I mean, everyone's been talking about the Converse one-star hotel pop-up event. Go and have a look at it online if you don't know about it. It was a great event, East London, trendy, fashionable, great brand promotion. But you're not going to run that sort of thing in Wigan. But Wigan is still going to need retail and community facilities. And there has to be a way of making sure that that shopping centre eventually is fit for purpose at the heart of that community.
And you didn't know this, Kim, but actually my surprise extra panellist is the Mayor of Wigan. I think I'm going to always include that in every session that I do from now on. What about Wigan as a question? Interesting. I mean, I ran a couple of panels at MAPIC, looking at experience, looking at the change. I mean, you do seem to have quite a big difference between what's viable for dominant centres and then the rest. That seems to be a problem that's happening in the UK first, but is then beginning to happen. And one of the interesting things from the Frankfurt one was that although there wasn't a negative view on retail, that actually Union Investment hadn't bought a major shopping centre this year. They'd actually invested much more in office, and this was the first time ever that they could remember that they'd not actually bought a major shopping centre.
If I can add to this, I think we've recently published a paper about retail, and I think one of the big fallacies in this whole discussion is that the big centres are safe. I think they are probably the most at risk, because if you have 200 or 300 potential tenants that you have to keep in trading actively, you can go through a variety of shopping centers also on the continent. I've been to one in Frankfurt. Even on the ground floor, you have dotted vacancies. Now, I come from a retail family, and many of these occupiers have in their contracts a clause that if the overall occupation of the center falls below a certain level, they can get out of their lease. And so you have a really delicate balance for an asset manager. And I think the big ones are not the safest one. I think there are quite others that you'd have to look into. And you find those also difficult to finance. We're financing a couple of London offices at the moment, and everyone wants to hear from us. I don't think we get the same response if we came with any shopping center, because the bank's appointed valuer, I guarantee you, is not going to agree with the vendors, and especially if it's a listed company valuers. And I would not want to be a retail valuer in these days, quite frankly.
Okay, good. And I'm sorry, I hadn't looked at my phone briefly. I'd got caught up. But there's a few things coming in. Peter, thank you for that. Gareth, his company offers an insurance guarantee to landlords instead of a cash deposit, but there's a reluctance by landlords to move away from cash deposits. So that's interesting. Somebody's picked up on the fact, Kim, that you said libraries. And isn't there a better resource for that? I mean, it'd be interesting to see, like, Mixed use, I think, will be an interesting thing, and I want to briefly pick up on that topic.
I mean, I think just generally, we've never seen as much capital from as many sort of different places coming into the market looking for product. I mean, anything that is core, it's got good income, is, you know, receiving very deep sort of bidding pools. We've got, you know, there's a lot of dry powder in the value add space. People are redefining what they think is opportunistic, and sort of adjusting their risk criteria and being quite positive on some of their business plans. But I also think we've got markets that have generally been starved of development for quite a long time. So, you know, I think the fundamentals in a lot of the different markets, and you can pretty much say that for offices, logistics, retail, I won't go into, you've just covered that. But I think that, you know, people want good product, and they're having to, in many cases, go up the risk curve to get their hands on what they're looking for.
Okay, good. Question here for you, Jos, as well, particularly, which is that yields are important, but what about liquidity repricing risk?
Yeah, I mean, people will remember Spain, which I did say was one of our top 4 markets, you know, in 10, 11, 12. Literally, investment volumes completely dried up. I mean, there was no liquidity in Spain. So you should clearly put a premium on markets where there is a deep, meaningful bit of liquidity. UK being one, Germany being another, France, I would say, probably in the possibly. The Nordics, I don't really operate up there, but I think they were pretty liquid post the GFC. They were less affected by the GFC. But absolutely, and places like CEE, where, you know, there's a lot of activity at the moment. I mean, again, that totally dried up after the GFC. So yes, I would say absolutely look at liquidity. Although clearly what we've just been saying about retail in the UK, there probably isn't any liquidity. So again, it's country and asset specific.
I would just add to that, I just think that, you know, what constitutes a liquid market or a sort of a gateway market is somewhere where you've got deep pools of domestic capital. And I think where that doesn't exist, that floor takes a lot longer to find. And I think that, you know, that's just, you know, if you're investing today and you're looking at those sort of dynamics, I mean, I'd be investing in big markets with deep pockets of domestic capital.
Okay, good. I wanted to quickly pick up on residential because, and also some of the alternative assets, because you mentioned healthcare. Morag, in terms of the residential, which you mentioned that you were particularly looking at, how do you see particularly the UK market and also the European market within that context?
I mean, I think there is a difference between Europe and the UK, and I'll speak from a resident of Amsterdam for 20 years. The relationship between people and their homes is quite different in the UK from other markets. I have chosen to focus in residential because I believe there is a lot of development that can be, and I don't mean building work, but I mean development within the institutional investment market there. Europeans are much more comfortable to rent. European institutions are much more comfortable having tenants who are residential people, who are people like us. They're you and me sitting at home paying our bills. I think it's a really exciting sector because what you've got in the UK is there's obvious demand. There's for supply, there is obvious demand from investors to invest in it, and it's getting that catalyst to work. And there is a whole other parallel environment out there called housing, not called resi investment, but it's called housing, where you have housing associations, where you have Homes England, where you have local authorities, where you have house builder developers trying to figure out how do we get more homes into that rental sector. Part of it is build to rent. I understand why institutional investors think that's the way to go. Personally, I think build to rent is not a formula that's going to produce the returns that they're hoping for. There's already pushback from planners that we don't want tower blocks with 300 apartments in it. We need family homes. So I think there's going to be a pushback there. We are in a niche market. We've deliberately gone into a niche market because we can see that if you get it right, we don't want to change the world, but there's enough capacity within a niche market, which we're doing the single family rental, to make investment returns. But yeah, I think residential is a really, really interesting market where right now we just don't have the exact simple route for an institutional investor to get into that market. There's a little bit of reconfiguration, but it just takes communication. And actually, let me just indulge me a little bit here. I read, this is what you need to write in your resume now, I hear, and I think the property sector needs to do it We need adaptability, we need analytical thinking, we need a proactive approach, we need empathy, and we need resilience. And I thought that just sums up what I think the property market has now got to offer to itself, to join up particularly with the retail and with residential, which I see as two markets where there's a lot going on, and there's a lot going on. I'm very optimistic about how we get through it. Might be a bumpy ride, but yeah.
Just quickly on the healthcare side, because it potentially a very big opportunity particularly within Europe, where you've got ageing populations. Picks in a little bit about that, the senior living side as well. But why the fund there? What's the opportunity?
Well, I've been doing senior living, assisted living, nursing homes since 2002, actually. So we originally, this was in my US Prudential days, we worked with Sunrise of the US, developing high-end private pay assisted living in the UK, and that went incredibly well. Interestingly, it went a lot less well in Germany, where in Germany there's much more of a sort of fragmented and public pay model, not private pay model. So we've ended up running a series of funds which basically buy those public pay or non-for-profit operated homes. I think obviously the issue that you'll always read in the papers about stuff historically blowing up in this sector is because of the operators. So it's one of these sectors in property, like student accommodation, like other things, where the underwriting and analysing the capabilities and credentials of the operator is incredibly important. And obviously in the UK, we've had big issues with the minimum wage, with energy prices going up, with local authorities cutting spending and budgets and allocations to elderly residents. So it's been a bit of a tricky, difficult market in the UK. But I think it's got huge potential in Europe. And our funds, the first fund did well, the second fund, we're raising money for that right now. So all happy. And obviously, everybody knows the demographic time bomb. So, there's many ways to attack, this market, and actually repurposing shopping centres in Wigan for elderly residents may be a good way to do that. Yeah. Good. Get the older people back in towns where they will spend.
Okay. Give me the big trend that you think for next year, and also where should people invest, should you choose to say that?
I think the big trend is going to be into residential. Partly because that's where I am, but I also think it offers the most interesting scenarios how to figure out what the solution is. If I wasn't working for a residential company, I would really love to get involved in the office market and figuring out that communication between what corporate occupiers want from their office space and how institutional investors can offer that. I think there's a lot of scope there for pretty exciting stuff as well.
Okay, good. Steve?
So I would invest in offices too. Probably in the core markets. I sort of, I hear what Kim said earlier about, it only takes a small shift out in sort of yields for there to be quite a dramatic drop in value. But I feel that, there are a lot of supply-constrained markets out there that don't have good quality office space. I think if you can invest in the right buildings, I think
your outcome certainly is a lot less binary than in some of the sub-markets where maybe you can get a little bit more yield, but I think you're taking on a lot more risk there. So I think that's where I'd be looking. From a demographic perspective, I think the senior living piece is interesting. I don't know how it pays for itself. I'm not sure many people do just yet. And I think, just looking at the way millennials are spending, I think the logistics and the e-commerce sector is going to keep moving forward and prosper.
Okay, good. Alexander?
I'm not sure whether I'm sector focused. I think in a competitive environment like this, it is all about the individual deal. Analyze it. And we run the slide rule for our clients over many, many things, and you discard 90% 10% is something interesting, and 5% you see, ooh, I think there has been something overlooked, a shift in tenant demand in a city from one part to another, a change in transport systems, many other things, a sector that is growing, alternative use value, all these things. So it really, for us, is only about a good deal, and they can pop up even in sectors that are completely out of fashion, and often do, but also in the main sector. So it's only about the deal, in my view, at this point in the cycle.
Okay, good. Kit.
You've stolen my thunder. That's what I was going to say as well. I think it's about income at this point in the cycle, and it is about looking at assets and making sure that they can deliver the income. And where you have got where there are opportunities perhaps to buy short leases, it's making sure that the asset is in a good enough location that you can actually deliver the performance where you're looking at taking some of that risk in the short term. But I don't think it's necessarily about sectors or locations. It is about that asset and that asset being able to deliver income at this point in the cycle.
Okay, good. Josh.
I think my top pick would be in town, edge of town, major cities, last mile logistic property.
Thank you very much.